Hello and welcome to Ticker Tapes. Today we're taking a look at the world of high growth stocks. It was as if a polar vortex descended over U.S. equity markets last week. The weather phenomenon often brings unseasonably low temperatures along snow and ice and is caused by a shift in the direction of the jet stream. In the case of the markets, the icy chill was caused by polarization in sentiment, as the market realized that U.S. inflation isn't heading lower and may head even higher than the annualized 8.6% shown in the data for May released last Friday. If we continue with the weather analogy, then these charts, which show the percentage of stocks in the NASDAQ 100 that are trading above key moving averages, can be linked to temperature gauges of investor sentiment around growth stocks, and in almost all cases, the markets have cooled rapidly towards them. Docu was the week's biggest loser, and it fell by more than 21% following the release of its Q1 earnings. DocuSign missed Wall Street forecasts for EPS of 46 cents by 8 cents, cut its revenue forecasts, and traded down to as low as $64.30, having previously posted a new one-month high at $92.04 as recently as the 8th of June. In fact, just 7 NASDAQ 100 stocks managed to post gains in last week's trade. 3 of these were Chinese tech stocks, with Pinduoduo up by 17.78% on an earnings beat, whilst compatriot JD.com added 8.83%. NetEase jumped by 3.18% on the week. The best performing domestic stock in the NASDAQ 100 was CrowdStrike, which finished the week up by 4.45% versus a fall of 3.6% for the index as a whole, which is now back to being down by more than 27% year to date. Why the rapid change in temperature? Well, higher inflation may mean higher interest rates, and investors fear that the Fed will be tempted to raise rates in larger increments in an effort to control rising prices. As a result, 81% of NASDAQ-listed stocks traded lower into the weekend. The recent recovery in the prices of technology and growth stocks was little more than a bear market rally, it seems, and for the moment, at least there is no reason to assume that we won't see many growth names trade lower still from here. The market orthodoxy says that investors shouldn't be in a rush to catch the falling knife right now. Instead, they should wait until the market tells us that it's reached the bottom, and in the interim, they can look around for quality stocks that may have been unjustly marked down, which should therefore bounce as when and if sentiment turns positive once more.